another session of the boys, and today we are going to be treating other income base. So probably this one is going to be 2.2. So now we are going to be treating earnings yield. Now remember that our P is what? We know our P as what? Market price. P is what? Market price over earnings. And we know our P ratio as what? Market price. Total market price. Let's do total market price. Over what? Total earnings, I mean? Yeah. Now when I want to deal with earnings yield, I will flip it to become the inverse. Then it is going to become what? Earnings yield will become what? Total earnings over what? Total market what? Price. So that's not the formula you need. This earnings, you know that is profit after tax you will use, and market price will be given, then you get your what? Earnings yield. So depending on the question, you know, they might say at the earning yield of this company, you use it for unquoted, for they will give you like quoted company, use it for unquoted, or they give you for similar companies, then you fix it. So and then it's going to be times 100 power. That's if you want to put it in percent, you put it times 100 over 1. So but you can leave it like this. Now, so we are going to treat the question. So let's pick a question. Or we just go to the study pack and
what's the earnings yield? What is it about?
Okay. Now, earnings yield, you know, from the word earnings, meaning profit after tax. Your earnings, you know, your earnings can grow. A company can say, okay, 2025 now, 2025, 2026. Their profit after tax, let's say it was what? 15 million. Now their earnings can yield what? Can become what? 60 million. That's earnings yield. It can increase. Earnings yield can grow too. Your earnings can grow from what? This to this. Using what? Earnings yield. And you can also use other companies' earnings yield to compare your own earnings yield if they are similar companies. So you can do that too. So you will understand better when we start treating questions. So any available question that we can treat. So we are just going to treat the question. Just let me call it. I couldn't find a lot of questions. Yeah. So if you have questions, you can send it to me. I will drop my email. You send questions. Let's see what we can do about it.
The earnings.
So question.
The earnings of Kickstart.
Wait, the company first.
The earnings of Kickstart.
Kickstart.
The private company were 450,000 last year.
Okay.
Stock market company.
Wait. Earnings.
Yes.
Last year.
Yes.
How much?
450,000.
450,000.
Stock market companies in the same industry provide an earnings yield of about 9% to their shareholder.
Earnings yield. That's what? 9%. So you are giving it in 9%. So that means you have what? 100 over 1. Or you can say that the earnings yield is going to be what? 0.09.
So required using the earnings yield method of valuation. Suggest a suitable valuation for the equity shares in Kickstart.
In Kickstart. So now let's just, the formula is straightforward. They are given, you said the equity what?
The said the requirement using the earnings yield method of valuation. Suggest a suitable valuation for the equity shares.
Okay. That's what they are saying we should get to the market value, the market value. So now, we are giving what? Earnings yield. And we are giving what? Earnings for last year. Then we can see our what? So solution. From this formula,
Yes.
you can bring this one here and bring this one here. So we see market value equals what? 450,000 over what? 0.09, which is what? If you put that,
That's 5 million.
5,500,000. Okay, 5 million. Or what?
500,000. Divided by 0.79. 5 million.
5 million.
Yes.
So we're having what? 5 million. So that's that. So that's just the answer to that question. It's a straightforward question. So if you have any questions, so you can just send it, so we'll treat it. But for now, this is the question I have. This is from the study part. So that's that for that. Okay. I have another question we want to treat now. But please, make sure you subscribe. It's very important. It's very important. So yeah, now, what's the question?
XYZ PLC.
Okay. This question one. So question two. X,
Y, Z
Y, Z, PLC.
is a company listed on the Nigeria Exchange Group.
That means it's quoted. It's a quoted company. Why? Because it is listed on the stock exchange. Next.
The following information relates to the company for the year ended 31st December 2025.
31st December 2025.
Profit after tax 12 million.
After
Tax 12 million.
12 million.
Number of ordinary shares in issue 4 million shares.
Number of ordinary shares
In
issued is what?
4 million shares.
4 million shares.
Yes. Current market price per ordinary share 15 naira.
So, market price per ordinary shares, or just say shares, is what?
15 naira.
15 naira.
Dividend declared for the year.
Dividend.
Declared for the year.
Okay, dividend. But what's the first requirement? You know, we've not gotten the dividend yield. What's the first requirement?
What requirement says calculate the earnings per share.
Earnings per share, B.
Yes. Requirement B calculate the earning yield of XYZ PLC. The last is state 2 reasons
Okay.
why investors may prefer
Dividend declared is what?
80 kobo per share.
80 kobo
Per share.
per what? Per shares.
Their requirements. The requirements now calculate the earnings per share. So the requirements now calculate the earnings per share.
So requirements.
Requirements.
So let's start with the first one. Requirements. Calculate what?
Earnings per share.
Earnings per share. Now, we know that from this question, we are not, we will do A first before we get to B. Now, what is earnings? Now, our earnings is already given. Our earnings is the what? Is the profit after what? Tax. Which is what? 12 million. This is what? Is profit after tax, which is what? 12 million. Now, you can say which what? Calculate earnings per shares. Now, normally it's earnings per ordinary shares we are going to calculate. Now, what is our what? Ordinary shares. Our ordinary shares is what? 4 million. Right? And they told us calculate earnings per share. Earnings per share will just be what? Earnings over what? Total earnings over total number of what? Shares. So that means earnings per share equals to what? Total earnings over what? Total shares. Total ordinary shares, I mean. Total shares. Total ordinary shares issue. So that's that. So then our total earnings is what? Is 12 million.
Yes.
Right? And our ordinary shares what? Is 4 million. That means our earnings per share, which I can write as this national, is what? No, not 3,000, it's 3.
Yes.
3 naira. 3 naira per what? So that's that part. So what is B? So now we are going to do the second question, which is B. So what's the second requirement?
Calculate the earnings yield of XYZ.
Calculate the what?
Earnings yield.
Earnings yield of what?
XYZ.
XYZ. So now, let's solve this. Let's do this. We know that our earnings from here, from this question, is what? Our earnings from here is, our earnings per share is what? 3 per share.
Yes.
And they say we should get our what? Earnings yield. Now, remember from here that earnings yield is what? Total earnings over what? Total market price. It can also be what? Earnings yield. We can also write it as what? Earnings per share over what? Market price per what? Per share. You will notice from that place, you will notice that they give us what? Market price per share. So I don't need to start doing putting it in total market price. I can just use this formula and then what? And then get it. So our earnings per share from here is what? 3, right?
Yes.
And I'm seeing this one times what? 100 over what? 1. Because I want to put this in percentage. Now, our market price is what? Is 15. So times 100 over 1. So that is what? I think 20%.
20%.
20%. Okay. So now what's the next question? The C. I think
The C states that state 2 reasons why investors may prefer earnings yield to dividend yield when evaluating shares.
okay. Now, earnings yield compared to what? Dividend. They say dividend declared at 0.08 per share.
That's 80 kobo.
Okay. Now, the thing is that we are not yet in dividend declaration. We are not yet in dividend yield. So I cannot go there. But I can just give you an idea of what we are going to do next. So now, from this question, our earnings yield is what? 20%. Then we can get our what? Our dividend yield too. Now, dividend yield too is still the same. It's going to go with the same what? the same formula. Now, it's going to be what? If I want to do for the C now, I can also say dividend yield equals to what? Dividend per share over what? Market price per what? Per share. So what's my dividend per share? 80 cup, that's 0.08. 0.80 naira over what? What is my market price? 15. So that means my dividend yield times 100 over 1. Let's do times 100 over 1. Times 100 over 1. LD will be what? Now, let me do this. 5.33%. Now, so okay, to those we are advising to either say 5.3%. This bar means that the 3 continues. So now, or let me just move it. Or approximately what? 5.3%. Now, compare this earnings yield 20%. Dividend yield 20%. Now, what's the question again? Can you read the question again?
The question is, state 2 reasons why investors may prefer earnings yield to dividend yield when evaluating shares.
Now, we are going to pick earnings yield because it's giving us more percent than what? Than you want dividend yield. So you are doing it by showing you what? The calculations. So after doing your calculation, you then explain that okay, based on the calculation that I've done here, I can advise the investor that they should go with what? Earnings yield.
Please help us state the reasons on the board so we can get it for proper understanding.
No, why can't you state it? Just the idea you need now.
No, we are learning from you actually.
You are not learning. So, we are going to treat another question. So let's see question 3. I'll start from here. Question 3. Now, can you give me the details of question 3?
Alpha PLC.
Alpha PLC, let's start from there. Always make sure you write the name of the company. Very important. Even if it's half mark. Alpha PLC.
And Beta PLC.
Beta PLC. So we have two companies. Okay. Alpha Beta.
Have 2 companies quoted on the Nigeria Exchange.
Now they said they are what? They are quoted, meaning that anytime you see quoted company, that means it is what? It is listed and the data are what? Are sanitized. Oh yeah.
Operating in the same industry.
Okay, similar industry, okay.
The following information relates to the company from the year ended 31st December 2025.
Okay, so the data related to this similar company is company are given below. Okay, now where?
So Alpha PLC, Beta PLC.
Okay, alpha and beta.
Yes,
Let me
yes.
see. So alpha, beta.
We have profit before tax.
Okay. Profit before tax, I mean. Profit before tax is what?
18 million and 25 million.
18 million. Naira. And this one is what?
25 million.
25 million.
Income tax rate 30% each.
Income
Tax rate
rate
30% each. 30% each.
30%. So both of them 30%, right?
Yes.
Okay.
Reference dividend.
Reference
2.4 million for Alpha. While Beta has
2.4. And for beta, million, that means there's nothing.
Ordinary shares in issue.
Okay, you can just give me the
Ordinary shares in issue.
Ordinary shares.
In issue, that's the issue of ordinary shares.
Okay, issue. Ordinary. Is what?
Alpha 6 million. Beta 8 million.
Eh?
8 million.
8 million. 8 million what? Shares, have you?
Yes.
Next
Market price per ordinary share.
Market price per ordinary shares. What do we have?
20 naira and 25 naira respectively.
20 naira and what?
25
25
naira.
naira respectively.
Expected annual growth rate in earnings.
Expected
Annual growth rate in earnings.
annual growth rate in
Earnings.
earnings.
That was all the table requirements.
What was it?
4%, 2%,
4%
and 2%.
and 2%. Okay.
So the requirements now required calculate for each company I profit after tax attributable to ordinary shareholders.
So they say we should calculate what? Profit after tax attributable to what? Alpha and attributable to what? Beta,
Yes.
right?
Yes.
Now, how do we calculate profit after tax? We are only given profit before tax, right?
Yes.
This is the value and this is the value.
Yes.
And they say the income tax rate is what? 30%, 30%. So what we need to do here is to do 30% of this will give us what? Our income tax, right? And 30% of this will give us our income tax. Then we subtract it from this, then we'll get our profit after tax. So let's just do that for A now. So that's going to be, we're going to do alpha. But let's do the calculation first. So for alpha, before tax, we need to get profit after tax. How do we go from profit before tax, profit after tax? We need our tax. Now, to get our tax, they're giving us tax rate. So just do 30% of this and this. No, if you do 70%, then you got into the actual value.
That's why I say you can see profit after tax is 70%.
So that was like 70 over 100 multiplied by this. Abi?
Yeah.
So let's do it that way.
No,
No, I want to break it down.
No, if you break it down,
Break it down. Now, me not saying that 70 I go do.
Okay, you wait to our listeners, you can break it down, sir. So what was the 30% of 18 million we started?
Oh, yeah, you started.
that is 600 something.
Is it on?
This is 6 million for 600,000.
Okay. So,
30%.
we are going to do 30% of 8 million.
That's 6 million.
5.4 million.
No, that's 2.4.
Is it 18 or
Is it 18? Oh,
open
Jesus.
your eyes.
Is it 18?
It's 18 now.
18 million. Yes.
5.4 million for the first one.
5 million. 400,000. Now, for beta, we have what? 30% of what? 25 million, which is what?
7.5 million.
7,500,000. So that's it. So now we've gotten our income tax. Then we will not break it through just to deduct it and get our profit after tax. Then we'll say alpha. We have what? Beta, right?
Yes.
We'll draw a table. So profit before tax. We have here, we have what?
18 million.
18 million. And here we have what?
0.5 million.
25 million. So now income tax. Our income tax for alpha is 5,400,000. 5,400,000. For beta is what? I think 7 million. Please let me do that.
17 million. No, 7,500,000.
500,000. That's 7,500,000.
Yes.
So when I subtract this, I should have got here 12 million.
600,000.
12,600,000. And here I should have got
17,500,000.
17,500,000. Now, we've got it this days. I still need to subtract for preference. Preference is like a debt. After I get this profit after tax, I still need to what? Subtract the profit, because they say concerning what? Ordinary shareholders. So we need to remove what is concerning what?
Preference dividend.
Yes, preference dividend. So we'll just come here and write what? Preference dividend. So this one, we are going to have what?
2.4 million.
2.4 million. And this one is having what? Nothing having.
Yes.
So when I subtract this one, what will I have?
10.2 million.
10,200 having.
Yes.
And this one I should maintain it having.
Yes.
17,500,000. Meaning that our profit attributable.
Okay, to ordinary
Profit attributable to ordinary shares for alpha. Now, profit attributable to ordinary shares for alpha now is what? 10,200,000. 200,000. And beta is what?
17,500,000.
17,500,000. So that's that for that. So that is that, yes. Now we've gotten this. Now the second question says you get what? What's the
It says that earnings per share, EPS.
earnings per share? So what gets earnings per share? That means earnings divided by what? Shares. And we know that this profit attributable to ordinary shares is profit after tax.
That's our
earnings.
Okay.
So now we are going to come here and then say we use this place. We'll say we are saying B now, we are saying we should get what? Earnings. So let's say alpha and what? Beta, right? So what's our earnings?
Our earnings is 10.2 million for alpha.
Which is what? PAT, right? So profit after tax. Now, for alpha, our profit is what?
200,000.
200,000. And our beta is what? 17,500,000.
500,000.
Because they are not paying. This one is more because they do not pay what? They are not paying preference dividend. So now, and we are looking for earnings per share. So what is this issue share for? It has to be what? Because this amount you are giving is the earnings per share for ordinary shareholder. And it's the earnings for ordinary shareholder. And this one too is what? Earnings for ordinary shareholder. So we have to divide it by what? Issued ordinary shares. So this one, issued ordinary shares. The first one we have what? 6 million and 8 million.
6 million shares.
6 million shares. And what? 8 million shares. So when we divide it, so when I'm going to if I divide this by this, then we have what? Our what? Earnings per what? Our shares. What do you have?
1.7 for the first one.
This one is what? 1.7 for the first one. The second one is what? 2.19, approximately, right?
Yes, sir.
Okay, now we are done with this. Yes, naira per what? Per shares. Or because we already said naira per share, yes, so no need of putting it again, but you can just put the naira. So this is naira per share, naira per share. So now, or receive. Now we've done this one. We've done for a alpha, we've done for what? Beta. So what's the next question?
Earnings yield.
Earnings yield. Now for the C. Remember, we know that our what? Earnings yield equals what? Earnings over what? Market price, right?
Yes, sir.
So what do we have in the question? We have what? Earnings per share. And I told you that the formula can also be what? Earnings per share, right?
Yes.
Over what? Market price per what? Per shares, right? You have it like this. So we have what? Earnings per share. And when we look at that place, can you hear me put? When we look here, we see that the market ordinary shares was 20 here, yes. And for our beta is what? 25. So you come in, we can say, we can draw a table to alpha and what? And beta. So the first one, we want to get what? Earnings yield. So now, if this is earnings yield, and they say we should get earnings yield, right?
Yes.
Now, so we just do this divided by this. So what's our earnings share per unit? Earnings per share is what?
1.7.
Earnings per share. This one is what?
1.7.
1.7. The other one is what? 2.19, right?
Yes.
So what's our market price per what?
20 naira.
Per share. This one is what? 20 naira. And this one is what? 25 naira. So now the formula states that what? This over this. So that means what? This divided by what? This. So what do we have? Times 100 over 1.
8.5.
So
8.5 for the first one.
So this is going to be what? 8.5 what? Percent, right?
Yes.
And this one is going to be what?
$8.76.
8.76. Now what's that the C and D?
The B part,
D.
it says that based only on earnings yield, advise which company appears more attractive to an investor and give reasons.
Now, based on the calculation we've done, we can advise the investor. Okay, let me clean this. So let me try to manage this piece. Okay, that's the B pattern.
Yes.
Or let's say it's the D part.
Let's say the B part.
Yes. Advice.
The question says,
Or report.
based only on earnings yield,
Mm-hmm.
advise which company appears more attractive to an investor and give reasons.
Now, based on the earnings yield, then, okay, just based on the earnings yield calculation, we can advise that the investor should go or invest in what? Or let's say to invest in Beta. Is it Beta PLC? Beta PLC. So now, the reason why is because Beta has more earnings yield than what? Than alpha. So that's just, but is there any other question there?